Starting off this hour is California. Chad is calling. Hi, Chad. How are you?
Good. How you doing, Dave?
Better than I deserve, sir. How can I help?
I had a question about mutual funds. I'm just starting to do the investing part, and I went to a broker, and I'm finding some good mutual funds with the good percentages, like you say, with the front-end load fee being about 5%.
5 and 3/4 is what most of them are. Yeah.
Yeah. I was just wondering if that's the 5, whatever you said, the 5 3/4%.
Mm-hmm.
Is that when you say it's a 12% return? Would that mean that I'm really only getting 7%?
Well, it's not 5 3/4 a year. It's 5 3/4 the first time you put money in.
Okay. See, I don't know everything, and I was
okay. That's okay. Let's talk through it. There's basically 3 ways you can get at this. Okay. There's what are called loaded mutual funds, which are mutual funds that have a commission, and there's no-load mutual funds that don't have a commission. There's 2 types of ways to get at the loaded funds. Let's talk through it for a minute. We'll use you as a teaching opportunity for all our listeners. Is that okay?
Okay. Yeah.
And then you just walk through me with this, and you got questions, you interrupt me as I go, okay? To start with, a no-load fund is not sold through a broker. You buy them directly from a company, and you'll see their advertisements in magazines and on websites and things. It's companies like Vanguard and Fidelity, okay? And they are primarily no-load, which means they don't charge a commission. Now, no commission does not always mean cheaper for 2 reasons. One is there's 2 or 3 ways they charge fees on mutual funds. All mutual funds have a maintenance fee annually, okay?
Okay.
Based on your balance at that time. So let's say you had $100,000 in there, and the maintenance fee was 0.75%. That'd be $750 that you were charged as a fee for maintaining the mutual fund, okay? Now, a no-load mutual fund has a maintenance fee. So you're still going to have a fee. It just doesn't have a commission, doesn't have the 5 3/4 or the other kinds of commissions we're going to talk about in a few minutes. So you do have a fee. Now, let's say that you, let's go back to our 5 3/4 example, okay? Let's say that you put $100,000 into that fund with that broker, and you paid the commission of 5 3/4. Well, that'd be $5,750, right?
Yeah.
That you paid up front. Now, then your maintenance fee on that fund, let's say it was 0.25%, only $250 a year. So for 10 years, that'd be $2,500. After 10 years, you would have paid in maintenance fees, $250 a year times 10. Do you follow that?
Yeah.
Okay. And then you'd have paid the $5,700 on top of that. And so we're talking about $7,000 and some change over $10,000. You following me?
Yeah. Okay.
Over 10 years.
So
now, the other one, let's pretend it had I looked at one the other day that was a no-load that I didn't buy because it was a ripoff, I thought. But it had over a 1% maintenance fee. It had a 1.2% maintenance fee. Okay, so $1,200 a year, right?
Yeah.
For 10 years on $100,000, that's $12,000.
Wow.
Okay, so you paid the commission on the other one, but it was cheaper. Do you follow me?
Yeah, that's what, in my mind, I thought, if I could go around the broker, I'm going to make a lot more money, but
not if you get one with a high maintenance fee.
Yeah.
So you gotta watch. They get you on the back if they don't get you on the front. Now there are good no-load funds that have reasonable maintenance fees, and sometimes I buy a no-load fund. Okay, I'm not against them. I'm just warning you that no commission does not always mean cheaper. You have to dig a little deeper to figure that out. Okay.
Yeah.
So that's the first thing. Then the second thing is with commissions. There's basically 2 ways that people are charging now. One is they're doing the 5 3/4 up front, like you're talking about, which are A shares, okay? And the second way is that they're doing what are called C shares, and the brokers will manage your whole portfolio for you. Instead of charging you a commission up front, they'll do it for 1% a year, okay? Which is not a bad deal because you got a broker there to advise you and teach you and help you for every year. If you got a good broker that's involved and you can call them, you see a bad news story about something and you're worried about the stock market dropping 400 points last week in one day and you want to call your broker, you got somebody to talk to. And there's actually research, Chad, that shows that if you have a good broker in your corner, you tend to make more because you tend to not make as emotional a decision.